In this episode, we speak with Peter Chung, CEO and Managing Director of leading global growth investment firm Summit Partners. For over 40 years, Summit has partnered with profitable, category-leading companies and their leadership teams seeking to build best-in-class businesses by leveraging their deep industry expertise and their peak performance group value enhancement platform. With over 80 growth equity investment professionals in their offices across North America and Europe, Summit has invested in more than 550 companies in the technology, healthcare, financial services, business services, and consumer sectors. Peter joined Summit Partners in 1994 and during his tenure has invested in more than 30 companies, including 18 currently or formerly publicly traded companies. He has served as the firm's CEO since 2015. Summit Partners was recognized by GrowthCap as a top private equity firm and top growth equity firm of 2024. I'm your host, RJ Lumba. We hope you enjoy the show. If you like the episode, click to follow.
RJ Lumba is the managing partner of GrowthCap and the executive chairman of Market Insight Media. He is the host of Growth Investor, a podcast featuring today's best investors, executives, and founders. In the minutes ahead, we'll uncover insights and strategies for accelerating growth and succeeding in business.
Peter, thank you so much for taking the time to chat with us today. It's a delight to be with you.
My pleasure.
Where I'd like to start is almost every alumnus that I've met from Summit is proud to say that they were once at Summit. What do you think it is about the Summit Partners brand that gives it that gravitas where people are forthcoming? I was there at one point.
Well, first of all, RJ, it's wonderful to hear that you've heard that. I would say this has less to do with our brand, perhaps, than with our culture. And I think we pride ourselves on saying that we have a culture of excellence and a culture of discipline and all those things that you typically hear from firms like ours. But I think another part of our culture is that we genuinely enjoy each other's company. And we try to hire folks who are very like-minded strategically. In other words, that they're believers in the investment strategy of the firm, which in many ways is what defines us. But that they're also people who with whom you enjoy spending time with. And I think that's been a part of our culture from the very beginning.
Mm-hmm. Obviously, to be successful, to build a successful firm as you have, it requires longevity among your team and folks that are truly driven to do well and help build the firm. What is it that makes an investor successful at the Summit platform?
Well, I think what makes you successful here is probably not dissimilar to what makes you successful as an investor anywhere. There are probably some common characteristics. I think discipline is a really important characteristic of any successful investor. We're a growth investor, so I think optimism is also a very important characteristic. Of course, work ethic, and we're still very much of the view that this is a very, very competitive business, and it's possible, but not perhaps probable, that you'll continually outsmart your competitors, but you can certainly outwork many of them. So work ethic remains a very important component of our culture, as well as I think those of many other successful investment firms. I'd also add perhaps a couple of other things. One is the ability to control your emotions. There's a John Bogle quote about emotion as one of the investor's greatest enemies. And I think we genuinely try to make the best business decisions we can relatively free of emotions. And then the ability to assess people and understand their motivations. I think that's a very, very important part, particularly as it relates to company selection and working with executive teams.
You mentioned competition, and we'll talk about that in a second. What's really interesting is you arrived at Summit in 1994, and I imagine the growth equity space was much different then than it is now. Can you tell us about what Summit was like in 1994?
Well, Summit was the challenger in 1994. We're a firm that was just 10 years old. We had yet to raise our fourth fund when I joined. It was a much smaller firm in almost every way, in terms of capital, in terms of people. We only had 2 offices at the time. And the industry as a whole was much, much smaller. So private equity and growth equity as a yet to be named subcategory of the broader industry were really in an artisanal phase. There weren't really true institutions in the business, and they were very much all partnership oriented. Many of those firms were still run by their founders. And of course, 30 years later, the industry's exploded in size, and many firms have become truly institutional. Several have become publicly traded institutions. And of course, the industry, I think, has become much, much more varied, much more segmented, much more deeply studied, and perhaps better understood by not just allocators of capital, but the general public, who are now expressing interest in alternative investing and finding ways to access alternative products.
And reflecting back on, the past 3 decades, as this momentum occurred in the growth equity space and new firms were coming in and, you found yourself maybe in certain situations competing, how did your kind of vision for the firm evolve? Did you sense that you needed to become more focused in certain areas? How did you want to interact with the competition or continue to steer the firm forward?
I think most of our emphasis has primarily been internally focused. As I mentioned, when I joined the firm in '94, we were the challenger. And several years later, we were at the forefront of the industry, along with a couple of other firms who I think had continued to differentiate themselves. And being the challenger is actually strategically actually quite easy. You're just trying to become or beat the market leader or leaders. We had to take some time to understand how to run the race from the front of the pack as opposed to being challenger. And the result of some of that self-reflection were an emphasis on things like continuous improvement and innovation. Again, these things all sound relatively benign, but when you apply them to the context of a firm that's been around for a long time and perhaps very stuck in our ways, you have to push yourself to improve individually and collectively. And in our view, that's the best path to maintaining your relative position in the industry, an industry which is becoming increasingly more competitive or became increasingly more competitive over the course of the last 30 years.
Mm-hmm. It seems that value creation by means of, strategic and operational influence has become table stakes. Can you tell us when that became part of what you do as a firm and kind of how it's improved along the way, where it stands today?
I think we were relatively early amongst growth-focused firms to invest in a value enhancement capability. We added our first value enhancement person, I believe, in 2007. Today, it's over 20 people, all of whom are employees of our firm. It is in many ways table stakes. I think the way people pursue value enhancement is very different depending on your focus, your industry sectors, the stage which you're investing, whether you have control or not, so on and so forth. Our approach was to build a value enhancement team and capability that was built from the ground up to specifically serve the needs of growth companies. We also decided early on to make our teams available to our portfolio companies free of charge. So we don't bill them for their time and attention. Over time, we've deepened our focus in certain areas and then obviously expanded the team, started from 1 to over 20 people now. And I would say, importantly, more recently, we've embedded that value enhancement team into our investment process. So 20 years ago, 15 years ago, the value enhancement was typically referred to as post-closing value enhancement. In other words, you bought the business and then you deployed your value enhancement teams. What we've tried to do is integrate our value enhancement teams much more deeply into our investment process from idea generation all the way through to exit. Again, this is with the view that deploying experts within our own organization to conduct due diligence will help us make better decisions. And again, I think that will continue to be our approach going forward. So our value enhancement team is organized into 4 different groups. There's a capital markets team who executes all of our financings on essentially a turnkey basis. We have a talent team, we have an operations team, and then a technology and data science team. So it's a platform of capabilities that we deploy against our portfolio. I think perhaps some of the uniqueness is the way in which each portfolio company engages with the value enhancement team is almost bespoke. You could work with all 4 of the teams, just one of them, 2 of them, 3 of them, or none of them. And I think that's the approach what we're trying to deploy, again, whether we have control or whether we're a minority investor, because the needs of each company are very, very different. The state of their markets, their industry subsector, where they are with respect to the leadership team and their human capital, and then, of course, obviously the investment strategy and whether they are users of our capital markets capabilities or not.
Now, Summit Partners focuses on distinct sectors, tech being one of them. Can you tell us about an area of technology that maybe you spend the most time in or that you're most interested in seeing how it evolves?
Well, the obvious answer is AI. Again, having been in the business for 30 years, I've seen pretty dramatic shifts and evolutions in the way that the enterprise customer consumes technology. When I started, there were still mainframes and mini computers around that over time evolved to PCs and workstations and client server architectures to web-based applications. And then maybe 20 years ago, we started to see true SaaS, single instance multi-tenant SaaS. So we're about due, if you look at the evolutionary cycles, for another pretty meaningful reboot in the software world. We're watching this very, very closely now. We're starting to pay attention to how generative AI will disrupt or transform software applications. I met with a friend of mine who's at a seed and Series A venture firm. He said they're not doing traditional cloud-based SaaS applications anymore. They're only looking at what he viewed as AI native software companies. So if that's what's going on in the early stage venture environment, I think eventually we'll start to see that in growth equity. So something we're watching. We're not quite seeing it right now, but there is quite a bit of chatter about that. Not just an architectural evolution towards AI native software companies, but also potentially a change in the consumption model, away from subscription towards consumption. And that, of course, would have pretty wide-ranging implications for enterprise software.
Mm-hmm. We're going to touch on healthcare, the other area of your focus. But before we do that, a little bit about your background. When you were growing up, did you always know you were going to head into finance and investing, or did you think you'd become a professional football player?
I actually thought I was going to be a fighter pilot. I always dreamed of going to the Air Force Academy and going off and being a fighter pilot. My father had been a pilot. My grandfather had been a pilot, and I just thought that's what I do. But I actually had an appointment to the Air Force Academy, but they wouldn't give me a vision waiver. So my childhood dreams were dashed.
So no football, and you decided at one point finance was the path.
Well, when I was in college, I graduated from college in 1989. So the Wall Street boom was still going on. And I had no idea what investment banking was, but all the smart people I knew from school were heading down to Wall Street. So I did the easy thing and interviewed at a bunch of the firms. And I just ended up getting an offer from Goldman Sachs. And I thought they were just terrific people with whom I could work well and from whom I could learn a lot. And that's how I ended up going off to Wall Street.
Okay. Now back to Summit Healthcare. Are there areas of healthcare that you're most interested in?
There are. I think one simple one I might mention is the veterinary sector. So, of course, almost every private equity firm in America owns a vet business. We were one of the first investors in the vet sector, making our first investment in 2007, I believe. But our thesis around vet has evolved quite a bit. We were one of the first consolidators of vet practices. Then we did a specialty veterinary business. Then we bought the leader in Europe. And then by that time, we thought multiples had risen to the point where we felt the risk reward was not as favorable as it was when we were first investing. So we stepped away from the sector for a while. Now we've come back in because the structure of the vet market, particularly as it relates to the labor market, has evolved quite a bit. And we're now looking at vet businesses that are very practitioner centric. And that's a very different dynamic than existed in 2007 when we made our first investment there. We're also very, very strong believers in risk-based or value-based care. We think that by aligning incentives, it's possible to deliver higher quality care, lower cost, and in some cases with broader access to that care. Again, simply by aligning incentives away from the traditional fee-for-service model that's existed in many parts of the U.S. healthcare system. And then we are taking a very close look at businesses that help advance research. So these would be businesses in the life science area where we can back companies that are providing products or services to help accelerate the process of drug discovery. Again, we've made several investments in this sector over time. It's not a particularly target-rich environment. Companies are very, very scarce, but we do think that there's a tremendous future for these businesses in decades ahead.
Tech and healthcare being the two kind of, I guess, more dominant areas where you focus. What would you highlight as the third area? I know there's kind of a mix of other sectors that you'll look at.
Yeah. So we have a third industry team, which we call growth products and services. Underneath that umbrella, there are four subsector areas of coverage: business services, industrial technology, financial services, and fintech, and then consumer. Those would be the other areas that we have dedicated subsector coverage.
There's another interesting part to your firm is in that you do public investing as well. You have a public equity team. When did that come about, and what was the impetus to having a public arm?
We originally had a joint venture with the entity, which is today part of our firm. That started in 1994, the year I joined the firm. So we've had a public equities affiliate, if you will, for a very long time. And several years ago, as that team was going through a generational transition, we just concluded it made sense to bring them onto our platform. And over time, they've become very closely integrated into our firm as a whole. They're aligned along the same industry sectors. They participate in our sector team meetings. And of course, in a very compliant manner, they provide insight on what they're seeing and hearing from public companies. And likewise, they benefit from the insights gleaned from our private market investing activity.
Thinking about some of the firms that have entered this space, some of them have actually ballooned in size quite dramatically. Summit has seemed to be a little bit more measured in how you're evolving. Is that due to the focus on the certain types and stage of companies you invest in? What's kind of your overall philosophy on where the firm is headed, either, size or strategy?
We're really, in many ways, a firm built around our strategy. That strategy, of course, is grounded in our fundamental belief that profitable growth is the most reliable source of superior risk-adjusted returns. As far as the growth of the firm, I can't really comment on other firms. I don't think that's perhaps not appropriate, but we think that our incentives are very, very closely aligned with our limited partners. We're the largest investor in all of our equity funds, and we're a firm that's owned exclusively by the current and retired partners. We're not a publicly traded firm, and we don't have third-party owner of the management company. So we're still very, very, very strongly motivated by the carry. If you balance that with the culture and the organization here, we're not run by a founding partner that controls most of the economics. I think we've been through a series of leadership transitions. Our founders did not put their names on the door. And I think if you were to ask Ro or Steve or Greg, they would say that that was because they wanted to build a firm that would persist well beyond their active careers. And in that sense, they've been highly successful. So that's the philosophy, the ethic that pervades the organization. And now 30 years in, I say I share the same goals that we're trying to make decisions here that are in the best interests of the firm for the next 40 years, not for the past 40 years of our history. And again, that thinking is the result of the culture of the firm, a very long tenured, stable partnership, and a lot of discipline and focus and embrace of the core of our firm, which is our strategy.
I've got two final questions that I like to end with. One is, can you tell us about a person that has had a profound influence on you?
Might say Jack McDonald. Jack was the legendary investment professor at Stanford Business School. He taught investing there for 50 years. I had really no perspective on a career in investing until I became his student in the fall of 1993. I took 3 classes from Jack and then also worked as a case writer for him. And he was the one that gave me the confidence that I could actually make a living as an investor. And in addition to that, with the passage of time, I could really reflect on some of the life lessons I learned from him about integrity and humility and gratitude. Those lessons become much more colorful as you get older and you travel the arc of your career.
Last question. Can you tell us about a charity, cause, or other endeavor that you're passionate about?
My wife, Betsy, and I, we support a number of faith-based charities, things like the Salvation Army or Mercy Ships, Athletes in Action. We're also very conservation-minded. We enjoy the outdoors. I'm an avid fly fisherman, so we think it's really important to be good stewards of the environment and of the outdoors. And so we'll generally support a number of causes that are in line with those passions.
Excellent. Well, Peter, I want to thank you again for taking the time. This has been a wonderful conversation.
My pleasure.